Thank you so much. So, management, after reviewing the financials for PICO and the trend over the years, would like to compare with your peer on the market, the only other listed entity. In terms of yield, considering that it is a property company, so look at the rental yield and the occupancy rates. The return on capital employed has already been explained. So we note that you were better off as a PICO compared to your competitor on rental yield consistently, and also on occupancy rates. You've been consistently above 90, 95, 99% compared to ICON. So that looks good in terms of rental yield and occupancy. Now we move on to comparing other metrics where we look at the asset turnover has already been explained. So just look at the debt liquidation ratio in terms of gearing. You've got some debt ICON doesn't have, but the ratios are showing that you're very appetizing to lenders in terms of your financials. You can actually get more debt and develop, which means that you are underutilizing your value. The loss, we've already explained that you are 10.82 while your competitor is at 16.79. Your competitor is more efficient in that area, but possibly it could be because they do not have any debts and they are also recovering quicker in terms of those that are holding money. So earnings per share, the difference is very slightly, but you are urging ICON in terms of the value you are providing to your shareholders. What we've discussed, we did now come to the final 4 observations. We've noted that consistently your profits, your rental income is dropping in percentage-wise year on year, whilst the value for properties is going up and even at a rate higher when you compare year on year. So you're relying on fair value, but your business is not into sales much. You're built to hold and rent. So that's our observation. We've also noted that on receivables, you are skewed 70% to offices, and most of that is leased to the government. The government takes time to pay rentals. We think you need to consider that. The government consider that they paid its arrears as at close of the year 2024. The arrears dropped from 8 billion to 3 billion, which is a plus. And observation number 3, you are lagging behind ICON in terms of profitability, the ROS and the return on equity. We note in the 2024 highlighted financials. The other years, we simply wanted to show the trend. We've noted an improved financial strength to shareholder in terms of the returns. Now, we are coming up with our recommendations, and we are saying that you need to rebalance your income streams. You need to consider reducing the concentration on the government by either bringing in more properties or discussing further terms. And you also need to make sure that you diversify into other type of property assets like retail. ICON is more weighted on retail. We've got 2 shopping malls, whilst we've got 1 shopping mall, but it appears you are not realizing much from that shopping mall. So there are several other strategies that you need to look into. We've also noted that you're lagging behind in profitability, so that has to be looked into. Yes, the expenses seem to be favorable, but that is when fair value is considered on the profitability. When you remove that, you notice that the gap is not that wide between expenses and the revenues. You also need to improve on the financial transparency when you consider the funds for operations and also the adjusted funds for operations, the EBITDA. The operational profits, you need to consider that. You need to be more transparent in what is building up that, so that it gives a clear picture to management, and also it attracts investors in whatever is happening. So the presentation we had, the analysis we've had, the 4 areas as highlighted by Faith in the methodology, and also the analysis, the vertical and the horizontal, our conclusion is that you're still a going concern. The earnings per share is good, but there's room to improve and that you can do more. Thank you so much.
Thank you. Value gains will still be there as the properties appreciating price. So how can they be reported so that the performance of the company can be easily justified?
Thank you so much. We'll take it, and let me first ask my colleague Daniel to start. Thank you.
Thank you. Thank you again for the question. I think, put simply, it is important for management to consider providing rates or rather property company specific metrics when reporting funds from operations. So there are some international best practices on how to report funds from operations for rate companies. And in this case, it would be important that instead of just reporting total income, that includes fair value gains, it is important to simply also report on funds, specific funds from operation, funds from operating activities on a separate slide or a separate statement to simply provide a clearer picture that is not distorted by those fair value gains. This is important because when you look at the graphs we presented also, PICO had negative cash flows in 2023 due to deferred tax payments. However, when you look at the financial statements, there's still a net positive on the profit, which is very concerning, especially if you're trying to make decisions on how to invest and move ahead. That's my take, but my colleague, the team leader, would be in a better position to add on to those statements.
Thank you so much, Daniel. And just to buttress the point, if you look at the gap between the income and the expenses, it is very wide, meaning that MPICO is very healthy. MPICO is reporting according to International Financial Reporting Standards, IFRS 16, which requires that they report on the property, plant, and the values. So that is incorporated to the income. But operationally now, for you to make decisions, we are saying if you could consider to take out that just to check the liquid cash that is there. You notice that in around 2023, the fair value gain was about 39% of total revenues. But in 2024, the fair value gain was 56% of total revenues, which speaks to either the fair values are increasing at a rapid rate compared to the rental income, or the rental income is not increasing at all or at a rate that is required. So we need to speak to that gap. So yes, you need to report on the fair values, but you also have to consider the liquid cash that you can use for either investment and also for any other payables. Thank you so much.